welcome to the Investor Coaching TV show. I'm Paul Winkler, your host. We're talking about the world of money and investing around here, and I'm going to talk a little bit about expectations today, and what causes investors to do really poorly is having improper expectations. Now, it's kind of interesting when you look at an investment portfolio. You have different time horizons, how long before I need my money back, but there are different things you can expect out of your investments based on how it's mixed. You can expect different things as far as 1-year returns, 10-year returns, 20-year returns, and so on and so forth. We're going to talk about that today. Now, one of the things we got to get clear is that a lot of the information I'm going to share with you today is based on the idea that you are actually following everything that I've taught on previous shows about how to manage money, what areas of the market to invest in, time horizon investing, and all of those things. So a lot of it all comes together in this particular workshop. And you've got to be following all of these things that I've taught pretty closely for the numbers to be actually valid in this particular show that we're going to be talking about today. So one of the things that we've got to remember is that if I'm an investor in the stock market, it's going to go up, it's going to go down. Now, if I want an investment that never goes down in value, never ever goes down, always goes up, it exists. It's called a CD, and you can bet that it's not going to make you any money after inflation. You're going to get zero return. It's going to take 100 years for money to double after inflation in an investment like that. Now, if I want some return that's going to give me some protection against inflation, I've got to have stock market-based investments. But how much fluctuation can I expect? How much up and down? You know, what is something that's reasonable to expect? Well, that's exactly what we're going to talk about. And it's going to be based on time horizon and those types of things. So let's talk about what we call the investment vortex. Now, a vortex is kind of like a funnel if you think about it. You know, that funnel comes together as we go down. Now, we're going to actually be talking about a funnel that is laid on its side in regards to your investments. So what we want to tackle here is how we can know that our portfolio is doing what it ought to be doing. How do you know if your portfolio, your investments, are performing within expectations or certain parameters? Because, you know, if my investments go up in value, is that good? Well, no, not necessarily. Did it go up as much as it should have? Or if my investments went down in value, is that bad? Does that mean that things are failing? No, not necessarily, because what did I say? Markets go up and markets go down. But if my investments went down more than they should have, then yes, I might have a failure problem here. So how do we know if it's working? Well, one of the things we know is that the average investor is not working. If you look at the average investor from 1992 through 2011, Dalbar did some research on investor behavior, and what they found is that the average investor over that 20-year period made about 3.5% per year. Really bad results. So, well, what did the market do? S&P 500. Now, if I want to choose the area of the stock market that has the lowest long-term expected return, one of the lowest long-term expected returns would come from the S&P 500, just owning the 500 biggest companies in the United States. But it's a benchmark that a lot of people use when judging how the stock market did. Well, that area of the market went up about 7.8% per year, so a whole lot higher than what the average investor got investing in the stock market from 92 through 2011. Now, why? Why is it that investors get such bad results? Well, here are a couple reasons. Number one, they typically tend to inadvertently chase hot asset categories. You know, we almost can't help ourselves. In the 1960s, people chased electronic stocks. In the 1970s, they chased oil stocks. In the 1980s, they chased bonds. In the 1990s, early 1990s, they were chasing, for example, international stocks. And in the early part of the 90s, that was happening. And then the late 90s, then you had literally technology. Everybody was all crazy about technology stocks. And then in the early part of the 2000s, after emerging markets did really well, people started dumping money into emerging market stocks. So that's one of the things that people tend to do. They also tend to inadvertently forsake diversification. Because they're chasing these hot asset categories, they end up owning putting most of their money in certain areas of the market, those areas that just happen to do well in the past. And of course, they don't buy them till after they do well, right? And then often what they do is they panic and they take money out of the market at the worst possible times. And then what investors tend to do, they tend to sell asset categories that are low, and they buy asset categories that tend to be fairly high. So they break the golden rule of investing. Now, without a coach, the vast majority of investors shoot themselves in the foot, because what they do is they lack the knowledge to set realistic investment expectations and discipline to maintain the strategy. They just don't have the discipline to make sure that they carry out the strategy. So that's what this whole workshop is about right here, is helping you get the right discipline when it comes to investing. Now, 3 simple rules that are going to help you avoid disastrous investment rules. And a lot of you already know them. Own stocks. Make sure you own stocks and fixed income investments. Diversify between different areas of the stock market. Large companies, small companies, value companies, growth companies, international, U.S., and you periodically rebalance the portfolio. In other words, if I have 10% of my money in one area of the market and 10% in another area of the market, and this area does better, now it's taking up 15%, and this is only taking up 5% because it doesn't do as well relatively, don't do what your friends are doing, which is buy more of that. You're going to sell some of this and you're going to buy some of that. That's rebalancing the portfolio. So these 3 rules, if you follow them, repeat them, then what ends up happening is you end up being disciplined and you end up being successful as an investor. Now, we're going to get through this, what we call the black hole or the vortex of investing. The tables and the graphs that follow, they're going to give you a visual image of the relationship between risk and return and expectations. And they're going to demonstrate how these factors affect an investor's portfolio over time. Now, you have 4 different mixes. I've talked about this on previous shows. 4 different asset mixes based on your time horizon. If I'm a conservative investor, it means I need all my money back in maybe 1 to 3 years. I'm going to mix my portfolio in a different way than a person that's got a longer time horizon. I may put most of my money in bonds. 75% is what you see right here, and I might only have 25% in stocks. If I've got 3 to 5 years, I might have half and half stocks, half bonds. If I have 6 to 9 years before I need my money back, all of my money back, I might be only 25% bonds and mostly stocks. And if I have 10 plus years before I'm going to pull all my money out and spend it, I might be 95% stocks, only 5% fixed income. So those are the 4 basic time horizons, and you see that, I might have a little bit in large U.S. stocks, a little bit in large value and small value. I'm going to be diversified amongst all these different areas. Now, the question we're going to answer as the show goes on is, what range of returns might I expect long run and short run out of these portfolios? And I promise it's going to be really interesting when you see what you might expect and how investors tend to sabotage themselves to get those really low rates of return. So this is a visual right here of the portfolios. Right here, what you're seeing is a visual of a conservative portfolio, which is mainly fixed income, a moderate portfolio over here, which is half fixed income and half stocks, and then a growth portfolio, which is mainly stock, 75% stock, 25% fixed income, and an aggressive portfolio. When we come back from this break, we're going to actually look at what you might expect out of these portfolios. Stay tuned after this for more of the Investor Coaching TV show.